Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. We've just released our monthly India Market Outlook titled Looking to Buy the Dips. In this episode, we discuss a key question on investors' mind. Is it the time to add to Indian equities? Well, Indian equities have remained under pressure over the past 6 months, driven by sustained foreign investor outflows, amid concerns of weakening domestic economic growth and corporate earnings, depreciating INR, and increased uncertainty over global trade policies. On the 4th of March, the Nifty index fell to its lowest level since June of 2024, recording a fall of nearly 16% since peaking in September of 2024. However, Indian assets have staged a broad-based recovery over the past few days, with the Nifty index up nearly 5% from its March lows. Broader markets have outperformed large caps, with the Nifty mid-cap and small-cap indices up nearly 8 to 9% respectively. The 10-year Indian government bond yield is down 12 basis points, while the INR has appreciated 1.2% against the US dollar. Now, coming to the most important question, is it really the time to add to Indian equities? While investor risk sentiment remains muted in the near term, given an uncertain global environment, we believe the time is right to buy the dip in Indian equities, supported by the following 4 factors. First, growth and corporate earnings cycle is likely to improve. India's GDP grew 6.2% year-on-year in the third quarter of fiscal year 2025, higher than the cyclical low of 5.6% recorded in the second quarter. Earnings for the Nifty index grew about 7% year-on-year in the third quarter of fiscal year 2025, improving from the 4% growth registered in the first half of fiscal 2025. Now, consensus estimates for domestic growth and Nifty index earnings over the fiscal year 2025 to fiscal year 2027 stands at a robust 6.5% for the GDP growth and 13% for the Nifty index earnings respectively. The second factor is that valuations have turned reasonable. The Nifty index 12-month forward price to earnings has eased to 18.8x, which is closer to the 10-year average of 18.2x and below the peak valuations reached at 23x. Further, the MSCI India price to earnings premium over MSCI Asia ex Japan has also eased to 57% from the September 2024 peak of 96% premium and closer to its 10-year average of 52% premium. Third factor is the easing of financial conditions. The RBI lowered its policy repo rates after 5 years on easing inflationary pressures, slowing economic growth, and the government sticking to its path of fiscal consolidation in the Union Budget of fiscal 2026. The RBI has also announced a slew of liquidity measures like FX buy-sell swaps, open market operations, and variable rate repo auctions to boost system liquidity in a seasonally tight quarter of Q1 2025. We see scope for bond yields to decline further and expect the RBI to cut repo rates by 25 to 50 basis points in the fiscal year 2026. And finally, the fourth factor, we think that bulk of the selling is likely priced in the current market levels. The Nifty index is trading below the key support levels, which is the 50, 100 and 200-day daily moving averages, with nearly 75 to 80% of its constituents trading below their respective 200-day daily moving average. Historically, market sell-offs have bottomed out when nearly 84% of the constituents of Nifty index fall below their respective 200-day daily moving average. In our view, the risk-reward has improved for domestic equities over a 12-month horizon, and we would use any drawdown to buy on dips. Within equities, we are overweight large-cap equities given better margin of safety in terms of earnings and valuations. We also see a tactical opportunity in small-cap equities driven by the following factors. First, the small caps have seen significant downward earnings revision over the past 6 to 8 months, which lowers the risk of further earnings downgrades. Second factor is that small caps allow access to a broader set of industries and subsectors to play the India structural story. And finally, the third factor, historically a period of easing liquidity and improving economic growth has been positive for small cap equities performance relative to the broader markets. That's it in this episode. Do reach out to your relationship manager for a copy of our India Market Outlook, or you could also find it on our website at sc.com/in in the SC investment section or Market Views on the go.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.